Hello, fellow traders. 'Tis I, the Rumpled One, coming to you Sunday, December the 15th, the year 2019. Let's talk trading. It's time for the weekly open and gap. Okay, we are entering the third full week of December trading. So, as always, risk management. Your risk on any given trade shall not be more than what you're willing to lose on that trade. So you will adjust your position size and stop loss accordingly. Okay, as you know, fellow traders, boys and girls, these videos are for educational purposes only, and your results may differ from mine. And that trading is very, very, very risky. You can lose all your money. That being said, if you need financial advice, investment advice, trading advice, seek it from an accredited financial professional. That way, when you lose all your money, you know you got your advice from an accredited financial professional rather than from some guy you heard on a YouTube video or read something from some trader on an internet forum. Okay, as you can see here, most of the gaps have filled, and I was definitely surprised. I was talking to a trader this morning, my time, long before the market opened, and I was saying that, I was going to bet that the pound dollar gap down huge, but I was mistaken. In fact, if you look at it, it did gap down, but let's see, we had an open price of 33.33, call it 33.34, and last week's close was at 33.43. So we had a gap of about, maybe 9 pips. Nothing to get too excited about, but hey, 9 pips is 9 pips. That's not a bad trade, right? On the dollar yen, we're only 27 pips below that yearly open. You can see here, once it tested pushback, twice it tested pushback, 3 times it tested pushback. What do you think will happen the next time? Will it break through and go green for the year? I mean, when you think about it, if you rode the yen for the entire year, it's just you're almost going to wind up where you started. And you can see here the first day of the month low, first day of the month high. We're in that zone, that opening range. And we're also in the opening range of the first day, trading day of the year. We're putting in the first trading day of the week range as I make this video. And once again, we can look at the weekly open chart here and see what happened. Inside bar traders, here we go. We had a daily inside bar 12 days ago, and we're inside that range right now. So it looks like a short at 109.32 and a long at 109.55 if you're trading that daily inside bar. And you can see here in the gray, we've got other possibilities for inside bar trades. Here on the weekly, we've got some brand new inside bars, and ditto on the monthly. The last month or last week when it's blue, that shows you it was just a fresh, out of the oven inside bar. Range, nothing to speak of because we're only a few hours into the opening day here. And we are in that wick zone of the previous day, but you can see that's a huge wick. And we'll probably see that in a couple of charts here. the weekly high and monthly H1 highest open, daily and the daily highest open right here. So there's the monthly H1 highest, monthly daily highest open, and you can see the lowest opens down here in blue. Buy zone, looks like we've already taken out the pivot. Pivot was just a pip or so above the buy zone, took it out. Strong trade once again. It's almost like money in the bank. But remember, your results may differ from mine. Range is too low for rat zone at the moment. And once again, we took out the pivot. Now, we've got a monthly pivot that we've already taken out. But we have a weekly pivot right here at 109.15, which is about 22 pips away to the downside. Look for this weekly pivot to get taken out. Missed pivots, we had one on Friday the 13th right there. But once again, we've got 7 missed pivots so far this year. On the weekly, we've only got 3, including the one from this week. But you see here, we went through all of 17 and all of 18, no missed pivots. And on the monthly, we haven't missed a pivot since the year 2013. But remember, fellow traders, sometimes it could take a while to hit a pivot. I mean, this is monthly. We missed this pivot. It took 1, 2, 3, 4, 5 months to take out that pivot on the monthly. So that's why you put your stop losses, because you don't want to be stuck in a trade for 5 or 6 months, right? Okay, price action, nothing to write home about at the time, but price most likely will not stay between 109.30 and 109.40. Take the breakout when you see it. And this wick zone is so huge. This is one of those days where price just may stay in the wick zone all day. Einstein line right now showing a short, but at this time of the day, usually don't trade this early in the session. And you can see why, because there's just that much happening tick-wise. For the range, you can see where the ranges are. It's really interesting that the daily range is overlapping half of the week, overlapping the halfway point on the weekly ranges. It's almost perfect. I've never seen that before. That's an interesting one. But you can see where we're looking for possible reversals here on the yen, on the upside and the downside, and then here where it might go for the week based on the weekly ATR. Now, squigglies. We were talking about charts last week, so I thought I should throw up a squiggly. Many people, they look at the 200 smooth moving average, which is the blue line right here. And, they want to be short below it and long above it, but you can see here, it doesn't always pan out. Now, the green line, that is the 50. And you can see the 50 is about ready to cross over the 200. A lot of people play these moving average crosses. And the 5 is just simply the smooth average here over 5 periods. But I also have in the slot machine indicator I wrote. When did I write that? Back in 2010. 9 years old. It just shows you how far price is above or below the moving average. Now, the thing about squigglies is, if I were to switch this over to weekly, all the values change. And so that's why I'm not a big fan. Because see here, they would say, well, you got a downtrend. I mean, the yen's below the 200 moving average on the weekly. Then if you switch on the month, oh, well, it's above the 200, so you got an uptrend. I mean, then you come back here on the daily, well, it crossed over, so now we're in an uptrend. To me, it's just nonsense. Because here, all this time you're below, you wouldn't want to go long and you could miss out on a lot. So, but I guess if you want to use it for a bias, it's not too bad. In other words, you go, let's wait for the price to get above it, and then we go long. There's profit to be made. I can't take it away. Now, if it's below, let's go short, and maybe you just take that moving average crossover. Because at any point in time, it's just going to be a point on the chart. It'll be one price. And for the most part, if it's a daily, it's pretty much going to probably hold that price within maybe 1 or 2 pips for the entire day. So it's almost like a horizontal line if you're using it for a cross. But if you want to use it for a bias, you can do that too. But I kind of got away from it. Now, the reason I have the EMA 5, because that was a really strong trade. In fact, indicator 2, if anybody has my indicators, that TROIND2, the famous indicator 2, where you just pretty much go along with that EMA. So if price closes above it, you just get long and you ride it till price closes below it. And you can see right here, price closed above it. If you got long, you took some heat, but then it came back, and you can see here there was a nice move till it finally crossed and closed below. So that's what you're looking for, is a cross and close above, or a cross and close below, and that's when you trade. And M5 was the time frame of choice to use that indicator. And in fact, this is the SMA, but we can go here, and this is the TRO tunnel indicator that gives you 3 moving averages. We can switch this over to a 1, turn that to an EMA. You see here over in the little comment section, now it's EMA. And so once again, cross and close above, and to cross and close below. Or you can just take profit, but you had a cross and close above. Right there was almost closed below, but you can see here then price. I don't really trade that way anymore. There were some guys that we used to use it in the stock market, and we used it in Forex. And if you're scalping, it can be profitable. But like I said, I got away from it. I just got into horizontal lines and looking at the wicks rather than a moving average. So for example, right here, you see price dipped down into that wick zone, came back out, broke out of the upper. So I could have gotten in a trade here, where if I'm looking at the cross and close above, I get in a trade here. And that's just one example. I mean, there's others where it could probably prove the other way. Let's see if I can find one on the chart. I don't see one readily, because here's one where you could have entered here, but you could look here. There was a turn trade. Here's another turn trade coming off a higher low. So you could have gotten in here, broken at the high. So you'd still get in before you get in on the moving average trade. But it's just it's a preference. You can use these for profit. But remember, boys and girls, these videos are for educational purposes only, and your results may differ from mine. So don't go out there and say I'm doing the horizontal, I'm forsaking horizontal lines for squigglies. No, I just thought since we were talking about charts, we should review all charts and some of these indicators. That's all. And like I mentioned before, this was an old 2010. You can use the 2017 dashboard to do the same. And the TRO tunnel just plots these squigglies for you. So, fellow traders, boys and girls, when you go out and trade this week, just remember, it's not what you trade, it's how you trade it. So everybody, go out there and drain the banks.